Blog Talk Radio.
Good morning from California. It's Brian Dooley, CPA with Tax Talk Radio. And today we're going over some loopholes. And I'm going to go back to the word loophole in a few minutes. Actually, my two favorite loopholes for small business. And as many of you know, I am enthralled with small businesses that are using robotic technology to expand themselves without incurring the burden and cost of employees. And the burden and cost of employees, not just the management, it's the office space, it's the overhead, it's the infrastructure of the computer system. So for my show right now, I'm going to find my assistant. It's Robert the Robot. And let me see if I can find him here someplace in my studio. Where are you, Rob the Robot? Oh, there you are. How are you doing today, Rob?
Brian, I am feeling fine. Thank you.
Good. Well, the loophole part of the show is interesting because we have presidential candidates historically saying they're going to balance the budget by closing loopholes. Now, this was big back in 1980 when Jimmy Carter got the deficit up to $1 trillion. And, of course, that was at the result of the war in Vietnam and the war on poverty done by President Johnson. And President Reagan was very popular and very much a proponent of smaller government. And we're going to hear from him later on today. And then we have both candidates saying now they're going to balance our budget, closing loopholes. So it's kind of interesting. I want to play a clip from both President Reagan and President Obama, if I can find it. Let me ask Rob the Robot to find it.
Yes. Brian, I will find it.
Okay. Here it is, thanks. Okay, so here's a clip of both of them, and you're going to be kind of surprised because you're going to think they belong to the same party. Hold on here.
And that's why this plan eliminates tax loopholes that primarily go to the wealthiest taxpayers and biggest corporations.
We're going to close the unproductive tax loopholes that have allowed some of the truly wealthy to avoid paying their fair share. In theory, some of those loopholes were understandable, but in practice, they sometimes made it possible for millionaires to pay nothing, while a bus driver was paying 10% of his salary, and that's crazy.
Middle-class families shouldn't pay higher taxes than millionaires and billionaires.
Do you think the millionaire ought to pay more in taxes than the bus driver, or less?
Warren Buffett's secretary shouldn't pay a higher tax rate than Warren Buffett.
Well, it makes pretty good sense. But the ironic part is that loopholes seem to persist. They seem to expand. Having started in taxes more than 30 years ago, I can tell you there's more loopholes now than ever before. So what is this about? And what are these loopholes? Why does your CPA not tell you about them? Now, last week we had a review of Mitt Romney's tax planning as explained in the New York Times, and I was fascinated by what a great job he did legally using a few of the loopholes in the tax law. And we only heard about those that the New York Times was aware of. So today I'm going to talk about two of my favorite for small business. And you know, when you look at a loophole, matter of fact, let's find the definition of a loophole someplace. Hold on. Rob the Robot, can you find me a definition online of loopholes?
Okay. Let me start my Google. Oh, here is Wikipedia. Loopholes were, historically, arrow slits were narrow vertical windows from which castle defenders launched arrows from a sheltered position. Thus a loophole in a law often contravenes the intent of the law without technically breaking it, much as a small slit window in a castle wall provides the only ready means of gaining entry without breaching or destroying the wall or a gate. For example, in some places, one may avoid paying taxes to the jurisdiction by forming a second residence in another location, or a commercial property can be built in a residential zone if it is made also for residential use. For example, in 2005, Walmart planned a store in Calvert County, Maryland. While a law in the county restricted the size of a retail store to 75,000 square feet, Walmart considered a plan that would dodge this restriction by building two separate smaller stores.
So that's interesting, isn't it? It's very subtle. We always think of loopholes as being income tax, but there's other tax law too. So I think what we're going to look at here is small business. It's getting close to the end of the year, and you're in tax planning, paying expenses or deferring income have some economic merit when the cost of money is extremely high and when there's certainty about the tax rates. However, right now we do not know what the tax rates are, and cost of money is kind of hard to determine. It's different for each business. So we're going to kind of go to the next level, the higher level, the sophisticated level, one that I think Mitt Romney would appreciate. And we're going to look at qualified retirement plans. Now, this is how Mitt Romney avoided the controlled foreign corporation rules. I watched a CNN financial analysis who was amazed and astonished that Mitt could have so much money in his 401k, more than $1 million, and he wondered how he did it. And that made me kind of wonder about the financial analysis on CNN. So this is how this is done. And small businesses can do it better than anyone else. When a small business is owned by a person who's in his 50s, the law of 401k retirement plans and other types of profit-sharing plans allow a substantially large contribution to be paid in to make up for his old age. And the point of these retirement plans is a couple of things. One, it's not income tax deferral. People talk about it, but that's not the main point. The main point is more of an equation, because a retirement plan that invests in stocks has an advantage. When it ends, you put the money into an IRA, you have a choice. You can either draw the stock out at its cost and get long-term capital gains when it's sold, or have ordinary income. This may seem a little boring, but it's not boring when it comes time to do your individual tax return, because one set of tax laws apply to ordinary income, a different set apply to capital gains. And it is important year by year to be sure you take advantage of each set of tax laws. Once the years pass, those laws are gone forever. So when you have a return with a lot of unused deductions, itemized deductions, sometimes other business expenses, you need earning income to be able to use those deductions. If you do not get earning income, you will lose the tax advantage of those deductions forever. This becomes more extreme with the alternative minimum tax. And if you're in a high tax state like New York or California, you're probably in this tax every year. So this technique, this loophole of you being able to decide what type of income you're going to have is tremendously important. It's the type of thing you need to be proactive with your CPA. CPAs are busy. They're not going to be calling you to do year-end tax planning. I mean, they send you a little newsletter, but you're going to need to sit down with them and get them to fire up that old computer and take a look. But the most fascinating of all small business loopholes or tax shelters is the stock ownership plan known as ESOPs. Many entertainers did this for their corporations, and you can do the same thing. And this is how it works. Usually when you get a tax deduction, you need to pay to spend money, right? You need to put money into your 401k plan. You need to buy equipment and deduct it or depreciate it. But during the Great Recession, money's tight. I like the Federal Reserve. They just print money and they do what they want. You can do the same with a ESOP. You print shares of stock. It gets treated as money. It's really simple. I have a corporation. There's 2 employees in it, myself and my wife, who does my translation. We do a retirement plan where we fund the retirement plan not with money, no, with stock. I go to my stock book over here in my file cabinet, grab 1,000 shares, sign it over to my ESOP trustee, who, by the way, is me, and I deduct it on my corporate tax return. Can this be any easier? I mean, how easy does it have to get? Eventually, I could put cash in the ESOP and do the IRA tax planning that I mentioned to you about buying stocks in the stock market. So there's so many great techniques. The key is to this tax blog talk is that the number of loopholes are endless. This is only 2. The tax law is literally 1 million pages. Nobody wrote them to be consistent. Do you ever get amazed by Google Map, how well it works? Somebody spent a lot of time to get that computer program code to be consistent. Well, not your government. They don't spend any time getting your tax laws to be consistent. And it is that inconsistency that is the crack in the wall of the castle that allows you to go in and out whenever you want. So this is today's episode of Tax Talk. I encourage you to be proactive with the CPA. Push him a little bit. He will find this for you. Remember, there is no end to the number of loopholes. You just need to find them for yourself. And with that, we will end this show, and I appreciate you all listening.